Today is one of those days when the market reporters can justifiably dig out their superlatives. Started with Chinese stocks crashing, more than 90% of the domestic shares down by the daily limit of 10%. Eurozone stocks then had their third worst day since the single currency was created in 1999, with the index falling 7%. Investors in the US panicked, with the Dow recording its biggest points fall in history before a rebound. Equities everywhere went into correction, down by a tenth, with emerging markets and Germany, the most exposed to China, entering bear market territory, down 20%. The scale of the fall was so extreme that it suggests a level of capitulation by traders. This is most obvious in the euro and the yen. Traders who had been borrowing cheaply in these currencies because of their rock bottom interest rates raced to close out positions no matter what they were. As a result, both the currencies had stunning rallies, the yen having its best day since the aftermath of Lehman. This chart here shows the euro's progress, and you can see just how much panic set in as it became clear that US equity markets were going to open with a really quite scary fall. The euro early in the day went through $1.15, but in the complete panic actually eventually hit 117 before coming quite a long way back. That faster and faster rally looks like a classic short squeeze, as those who'd borrowed euros rushed to close out their positions, in turn pushing the market up further as they had to buy euros to cover what they'd borrowed. When the rebound came though, it was fast. You can see that in the euro, it came in three separate legs. We had very similar moves in other markets, the Dow, for example, making back more than half of its loss. And the big question is whether this was merely a short-term bounce because the fall had been so extraordinary, or one of those major buying opportunities which come along every now and again. Now, sentiment measures do show genuine fear out there. In the currency markets, traders scrambled to buy protection against extreme outcomes. They even pushed up the price of options on the Hong Kong dollar, breaking its peg to the highest in more than a decade. In the US, equity options are showing the triumph of fear over greed. This grey line here in the background shows the ratio of those using options to protect against a price fall against those using them to bet on a rise. And that's then a higher number means that they're more worried, they're buying more protection. The 10-day average, which I've got on here in red, is now at the highest since back in 2012. And of course, 2012, that was the height of the Eurozone crisis. People thought that the currency was going to break up. Now, other sentiment measures also suggest that the bears very much have the upper hand, which is a classic sign that there's a short-term buying opportunity out there for those who can resist the scary headlines. But while traders can play the short run, investors need to think longer term. Investors had been overly complacent about China for a long time, allowing developed equities and bonds to ignore the growing problems in emerging markets. Sudden recognition of these problems may have led overall markets to overshoot somewhat, but the problems haven't gone away. Even after their falls, US shares remain really quite expensive, with little sign of top-line growth, while emerging markets are nowhere near cheap enough to attract proper bargain hunters. Short-term bounce can reasonably be expected after such a large fall, but for the investor, the position remains substantially unchanged. They have the choice of buying overpriced developed market shares or bonds, which offer very low long-term returns, or they can bet on a Chinese recovery by taking the risk of buying bombed-out commodities or emerging markets, or they can sit in cash and wait for a still bigger fall to provide a genuine long-run buying opportunity.